Hello, welcome to MiloXWorld. I'm a successful trader, and I want to share with you the strategy that has allowed me to generate a considerable amount of money in the stock market. From my early days in trading, I always sought a method that was not only profitable but also systematic and safe. After trying various strategies, I found the one that truly transformed my way of investing, the wheeling strategy. This approach combines cash-secured puts and covered calls, enabling me to maximize my gains while effectively managing risks. In this article, I will explain in detail how the wheeling strategy works, why it is so effective, and how you can also apply it to achieve similar results. Additionally, I will share my personal experiences and some specific examples of how I have used this strategy with stocks like SOXL, TNA, TSLA, AMZN, Google, TSLL, CLSK, RIOT, and Mara to generate consistent income. Get ready to discover a method that can change your financial life. Don't forget to like the video and subscribe to the MiloXWorld channel for more uplifting content like this. What is delta in options? Before delving into the wheeling strategy, it's crucial to understand the concept of delta in options. Delta is one of the Greeks in options trading and measures how much the price of an option changes for every dollar change in the price of the underlying asset. Essentially, delta gives you an idea of how the option price will move in relation to the stock price. Examples of delta. Call option with delta 0.5. If you buy a call option with a delta of 0.5 and the stock price rises by $2, the value of your option will increase by approximately $1. Put option with delta, negative 0.3. If you sell a put option with a delta of negative 0.3 and the stock price falls by $3, the value of your option will increase by approximately 0.90. Call option with delta 0.3. This is the configuration I usually look for in my covered calls in the wheeling strategy. If I sell a call option with a delta of 0.3, I aim to generate cash flow while waiting for the shares to be sold quickly so I can reinvest. What is the wheeling strategy? The wheeling strategy is a technique that uses cash-secured puts and covered calls in a continuous cycle to generate consistent income. Here's a breakdown of how it works. Cash-secured puts. You start by selling cash-secured put options. This means you sell an option that obligates you to buy a stock at a specific price, known as the strike price, if the stock price falls below that level before the expiration date. To secure this trade, you must have enough cash in your account to buy the shares if assigned. In my strategy, I aim for the premium paid for these options to be around 1% of the total at risk, and generally choose a weekly expiration date. This allows for higher capital turnover and the opportunity to quickly adjust the strategy based on market behavior. The ideal time to sell puts is when the stock is falling, as this provides a higher premium. Assignment of shares. If the stock price falls below the strike price, you get assigned the shares and must buy them. But this is not bad news because you have already collected the premium from the put option and bought the shares at a lower price. Additionally, by selecting a 1% premium, you have an initial gain that cushions any further decline in the stock price. Covered calls. Once you have the shares, you sell covered call options on those shares. This means you sell the right to someone else to buy your shares at a specific price or strike price before a certain expiration date. To maximize the efficiency of this strategy, I look for call options with a delta of 30%. This is because my intention is not to hold the shares for a long time, but to generate cash flow and have money available to continue the wheeling strategy. If the stock price rises above the strike price, your shares will be sold, and you will receive the stock price plus the call option premium. The best time to sell calls is when the stock is rising, making an upward move. Repeat the cycle. If your shares are not sold, meaning the price does not rise above the strike price, you simply keep selling covered call options. If they are sold, you go back to step 1 and start again by selling cash-secured put options. Success examples. Direxion Daily Semiconductor Bull 3X shares, or SOXL. I sold SOXL put options at a strike price of $50. When the price fell to $48, I was assigned the shares. I sold covered call options with a strike price of $55 and a delta of 30%. The price rose to $57 and my shares were sold, generating significant profits in the process. Small Cap Bull 3X shares or TNA. I used the same strategy with TNA. I sold put options at $30. When the price fell to $28, I bought the shares and then sold covered call options at $35 with a delta of 30%. The price rose to $38 and again, I achieved profits both from price appreciation and premiums. Tesla Inc. or TSLA. I sold TSLA put options at $150. The price fell to $145 and I was assigned the shares. I sold covered call options at $175 with a delta of 30%. When the price rose to $180, my shares were sold, maximizing my gains. CleanSpark Inc. or CLSK. I sold CLSK put options at $15. When the price fell to $14, I was assigned the shares. I sold covered call options at $17 with a delta of 30%. The price rose to $18 and my shares were sold, generating a good return. RIOT Platforms Inc. or RIOT. I sold RIOT put options at $20. When the price fell to $19, I was assigned the shares. I sold covered call options at $23 with a delta of 30%. The price rose to $24 and my shares were sold, achieving gains from both premiums and price appreciation. Marathon Digital Holdings Inc. or MARA. I sold MARA put options at $12. When the price fell to $11, I was assigned the shares. I sold covered call options at $14 with a delta of 30%. The price rose to $15 and my shares were sold, maximizing my profits. Other examples: Amazon or AMZN, Alphabet or Google, and Direxion Daily TSLA Bull 3X shares or TSLL. The same strategy has been successfully applied to stocks like Amazon, Alphabet, and Direxion Daily TSLA Bull 3X shares, always leveraging volatility and option premiums to generate consistent income. Conclusion. The wheeling strategy is a powerful and relatively safe way to generate income in the stock market. It requires patience and good risk management, but the results can be tremendously rewarding. The key is to sell cash-secured put options and, if assigned the shares, sell covered call options with a delta of 30% to generate cash flow and have capital available to continue the cycle. This cycle not only allows you to collect premiums continuously, but also provides opportunities to gain from the appreciation of stock prices. I encourage you to try this strategy and see for yourself how it can transform your way of investing in the stock market. Don't forget to like the video and subscribe to the MiloXWorld channel for more uplifting content like this. Happy trading!